Hey everybody, Marty Missouri here. It's Tuesday, June 20th, after hours, shooting your midweek stock market snapshot that'll be emailed to clients, attached to the email tomorrow morning as Wednesday morning's message. Going to do what I've been doing over and over again for weeks and weeks now and just simply look at the S&P 500, the QQQ, the ETF that tracks the NASDAQ 100. I do want to look at the VIX again. I do want to look at the dollar again. I want to look at a measure of overboughtness that we track each week that I don't often share here. And then I want to run through an article by Bloomberg's John Authors that I thought was very well done. And he kind of explores the case that we are in a new bull market versus the case that this is a bear market rally. He, rightfully so, doesn't come to any conclusions. He just kind of points out both cases. And I want to give you my take on what he has to say and maybe supplement some of the data or at least comment on some of his commentary along the way. I think that'll be very instructive. And for you clients, most importantly, it'll, I think, have you appreciate, not that you don't already, our view and why we think we need to remain a bit cautious here and while continue to ride this rally as long as it goes and grab some returns along with it as we've been able to do of late, but have the portfolio also with a bias towards some protection if indeed things do roll over, which we think odds still lean in that direction right here. The moral of the story, and I'll probably say it again when I skim through John's article, is that we here at PWA are not in the business to be bulls or bears, to be cheerleaders or cynics when it comes to the stock market. It is to assess the global macro environment and come up with a risk-reward thesis and then allocate our clients very important long-term money accordingly. Okay, so in front of you is that daily chart of the S&P 500. And not a lot has changed from the last report. We're actually breaking out below or breaking down below this rising wedge pattern. So that would be a bearish, that would even be a sell signal, frankly, against, still a bearish divergence because we don't have a new high in the MACD. And the most overbought, based on the RSI, we've been during this entire bear market. So we'll see how this plays out over the next few days and weeks. I do want to show you the hourly chart today. So this one, each candle is 60 minutes, going back 60 days. And as you can see here, we had this new high here on the hourly over a 2-month period or so. And we have broken down below this kind of channel pattern in here. And we got a sell signal on the MACD. So even though we came back and tested that or tried to today, then failed that test, this is a very, very bearish look here on the shorter term chart. And this looks very much like a bear flag pattern. So if this week is going to continue as Tuesday has started out, then we'll see that happen over the next few trading hours starting tomorrow morning. And that would be, for a few days period, that would be a pretty good sell-off in the S&P. Not making that prediction, just telling you that that's not out of the question by any stretch when I look here at the hourly chart. As for the NASDAQ 100 or the ETF that tracks it, it's tried to break out here below, close right on the uptrend line here, pretty much right on that, close enough for sure. Still, that longer, bearish divergence, only because we haven't been able to peak to a new high in the MACD, and it's rolling over. Hugely overbought, still above 70 on the RSI again. An extended overbought period like we haven't seen through this entire bear market so far. Then on the 60-minute chart for the NASDAQ 100, Same thing that we just saw here on the S&P. Breakdown below the rising wedge, sell signal right here on the MACD, falling hard off of overbought territories. So yeah, very bearish look technically on a very short-term basis. Again, folks, we've seen this over and over again in this either new bull market or bear market rally. Powell speaks before Congress tomorrow. We'll see what kind of tone he wants to set for the market. We've been tracking the VIX, and as I've pointed out, it's a very bullish look for the VIX, the way we look at the technicals, and it has been here now for last week or so. Remember, we broke out of this falling wedge pattern, and interestingly, that big update in the VIX coincided with an update for the market. I ran an analysis for you using the VIX for the NASDAQ 100 here recently and showed the atypicalness of that and how it can be a bearish signal. This morning on the written blog, I featured John Hussman graphing the same analysis in conjunction with all the bullishness we've been pointing out of late. He too feels that it's a legitimate concern for this rally right here. And then we just kind of continuing down into this bullish falling wedge with bullish divergences, and a big spike in the VIX, and it's really, really low relative to where it's been in quite some time right here, meaning volatility is cheap. We took the opportunity a few days ago to push our hedges out further because that obviously has a real impact on the way we hedge our portfolio in terms of the price. So I think of kind of a precarious setup I've shown you here along the way, what these setups tend to portend, and these big jumps in the VIX correspond typically with quite the decline in stock prices. So another warning flag right here as far as we're concerned. And the dollar, we got bearish the dollar in our last equity market conditions update, which we do monthly. That was actually a bullish sign for stocks. We did our analysis up in here. We had our classic signals that the dollar could indeed roll over. Indeed it has, and that it just perfectly corresponds with the rally we've seen in stocks so far during the month of June. It's not quite as bearish right here. It'll be interesting to see when we do our end of June update. We see now 4 days in a row with strength in the dollar. We see the MACD histogram kind of giving us a prelude to maybe a curling back up and getting a buy signal. That would be bearish for stocks. But again, this was one of just a couple of bullish things for the month of June going into it that said that this could be bullish for stocks in the short run. Longer term, that indicator that we put together does not paint a good picture for anybody who wants to increase their long-term exposure to equities right here. And then that other indicator I wanted to show you, typically with regard to the Bollinger Bands, we use it on a monthly basis, and a couple times here over the last couple of weeks I showed you a very bullish look because on the monthly we crossed above the 20-month moving average and we closed above there in April, and that the vast majority of the time denotes the end of a bear market, except for when there's a recession shortly following. That's when historically that has turned out to be a very false signal. Our recession indicators are still flashing red, so that could be another replay of that rare time when that particular signal fails. This is the daily Bollinger Bands, and it took it back to a few months before the recent top, or the top in January of last year, which is, since then we haven't, that was an all-time high, and we're having our bear market, or have had our bear market. One thing that I could say from a Bollinger Band perspective, we are resoundingly overbought, and we've been that way for a while. So by the way, I talk about being overbought as somewhat near-term precarious. Well, they can stay there for quite some time, right, before it finally rolls over. Typically, it doesn't come off of these levels without something that you feel in terms of a correction, right? You can see it here right at the peak, climbed up here. And by the way, this is the 20-day moving average. This is 2 standard deviations above that is the purple line. And you can see what happened there. Came back, and we had this pattern. Remember that one? We talked a lot about that as it was going on. Not related to the Bollinger Bands, but just the shape of the price chart. Got overbought here, got there, bounced around, and before we finally rolled over hard to the so far bear market low. But you get my point. When you start pushing against that purple line, you're pushing against a pretty hard ceiling, and you can see we got really overbought in there. We had a good correction, and here we are climbing along there, folks. So this would suggest that this is going to resolve itself with something that peaks back down below the 20-day moving average and maybe tests oversold level at some point. With all the bullishness that's been showing up lately in individual investor and professional investor sentiment, this is feeling really, really toppy, as I continue to point out. Okay, so let's get to that article by John Authors. He titles it The 20% Up Rule, Bull Market versus Bear Market Rally. So folks that I respect, and some folks who even pay for the research like Bespoke Investment Group, they really cling to that new bull market, right? Because we're up 20% off the low, okay? So what John says, and I'll do my best paraphrasing the things that he says here, but I won't miss his key points. Like a scratched record on repeat, market watchers have warned that the rally in stocks, which has briefly proclaimed a bull market after rising 20%, is too reliant on a handful of mega cap tech firms. You've heard that here numerous times over the last few weeks. Well, Lisa Shallett, Chief Investment Officer at Morgan Stanley, put it this way: exuberance around artificial intelligence along with a resilient dollar has produced extreme divergence and concentration risk in the main stock indexes. Such narrowness is not what bull markets are built on. And as you know, we sympathize with that. John kind of pours a little cold water on that. He says, whether this is good or bad is subjective. Your answer will probably depend on how you are positioned. And while we're making money in this market, which means we're positioned net long for sure, but we are talking more about being defensive than we are about being aggressive right here. Points of return discussed the S&P 500's top-heavy concentration last Wednesday. It must be a Bloomberg program. And concluded that narrowness isn't necessarily all that bad. In fact, history shows that equity upside has typically come from a narrow set of companies. Further, once the relative performance of these big gainers have subsided, the broader market has historically held up just fine. Now, I've pointed to the fact that we haven't had this kind of narrowness since the tech bubble burst. And folks, with so many of these indicators that lean bullish right here, that tell us that, hey, the worst may be over. When I go back and look at that history, and I'm sure there's going to be some exceptions, but I'd say so far, virtually without exception, when there was a recession shortly following or looming, or in retrospect during those signals when they got hit, that's when narrowness was a very bad thing, right? That's when other things that we pointed out that are bullish turned out to be false signals. And while our recession indicator is still flashing red, we have to be careful right here with these bullish signals. So now that the rally has topped 20%, is it a new bull market or simply a rally within an ongoing bear market? Pundits on either side will be able to make their cases. The case for a bull market, going by the most famous, though irrational, couldn't agree more, definition, a bull market can be declared if the benchmark index has risen 20% or more from its recent trough. This one has done that, right? We're just above that. He points out here, however, from 1929, too many to count, 20% rallies. And by the way, a number of those happened, particularly for the NASDAQ during that tech bubble bursting. And we had several rallies that would have been new bull markets, all amid a 30-month, really, really ugly bear market. It's been a while, roughly 236 days to be exact, since the bottom. Very, very unusual for the stock market to go back to that low. The nadir of this cycle was October 12th, 35.77. That must have been the closing nadir, because it got to below 3,500 on October 16th, and that's what we're calling the bear market low. But that was intraday. Before the gauge rallied upward, back then, Bloomberg's Jan Patrick Barnett reported that the average number of trading days until the S&P bottoms, on average, though, is 318. So if October really was the bottom, it is surprising that it ended when it did after just 195 days. But again, it's also unusual for a recovery to last this long without revisiting its low and not go on to endure in the longer run. So Tom Sohn of Strategas points out that the S&P broke the 12-month streak of negative year-over-year returns in April. It's unusual for negative returns to persist so long, and historically, the market has been up a year after breaking that streak from 2% to as high as 38%. At the very least, it would suggest that maybe the worst is behind us. Volatility is quite non-existent. I just pointed to that. On the VIX, very unusual to have the VIX this low, which tracks the cost of implied volatility in S&P index options during a bear market. He points that out. What earnings recession? He points out that we were bracing for a horrible earnings cycle, but it hasn't been that bad. He says it's been good. Forecasts have been revised higher, and even more so in Europe, implying that prospects for corporate profit growth look better than many have realized. Crucially, much better than many had believed back in October. Can that really be achieved? Evidence of such an outcome can be found in resilient sales, lower transportation and energy costs, as well as a weakening dollar, which we've touched on. And because all these combined are raising analysts' earnings expectations, they are also revealing some notable entry points for investors, according to JP Morgan. I could argue that these lower costs and so forth are consistent with a weakening economy and what we're seeing in terms of those recession signals, which would not be good for stocks, I can assure you. To be sure now, some like Morgan Stanley's Mike Wilson, one of Wall Street's biggest bears, after accurately predicting the 2022 sell-off, still thinks there could be a meaningful earnings recession this year, a roughly 16% decline in earnings that has yet to be priced in. This, he wrote Monday, will be followed by a sharp EPS rebound in 24 and 25. So this is what you got to like about a guy like Mike Wilson. Mike Wilson is not a perma bear, right? He's telling you right now that there's going to be a time in 24 and 25 to be bullish. I may like him so much right now because his thesis comports very closely with ours in terms of what the expectations are, or what our expectations are. But some people have asked me, what do you think of this person? What do you think of that person? And more often than not, the bulls are always bulls, the bears are always bears, or too often for comfort, let's put it that way. Gets a little frustrating, to be honest with you. A guy like Mike Wilson could very well be wrong. We could be wrong per se, and I'm using air quotes, because it's not about being right or wrong. We could be absolutely right, and we think we are, in terms of the risk inherent in the current setup that keeps us somewhat defensive. That doesn't mean we're making a prediction that the market's going to fall out of bed. Mike Wilson is making that prediction, and maybe he needs to do that in his capacity. We don't want to do that. We just want to say Mike Wilson is pointing out the risk that we're seeing as well. He says bearish sentiment writ large. I think that definitely was the case. And it was the case at the bottom. And by the way, we were drawing very bullish patterns off of that bottom. Those of you who've been watching the videos consistently would tell you. And but one thing's for sure, that bearish sentiment isn't there today in your usual places. Our bull bear barometer, or our fear greed gauge, I should say, is a minus 75. And the way we score it, that's really close to extreme optimism, right? Minus 100 would be just massive optimism. The Citigroup Fear Greed Barometer is at the extreme optimism, and that's a dangerous place to be. So that's where we're sitting right now. Very, very bullish sentiment, which tends to be a marker of a top, just like excessive bearish sentiment is a marker for a bottom. Okay, so the case for the bear market rally. Stocks are way too expensive. We have four or five different valuation metrics in our equity market conditions barometer, and they're all just screaming stocks are expensive. So that's the case they make here, and he gives you some historical references here that tell you that this is just an unusually expensive market. And he has a chart here relative to where stocks tend to bottom. Stocks look more expensive than at previous market bottoms, is the point he makes there. Alternatively, the cyclically adjusted PE ratio, Robert Shiller's Nobel Prize work, the higher the yield, the cheaper the stocks. So he has another chart here. The last bull market started with stocks way cheaper than bonds, and that pattern is not remotely on display today. So you really do not have those classic bear market bottom, new bull market signs, or at least you don't have a whole lot of them. Way too narrow. Now he plays the bear's position here on the way too narrow part. It has been said by dozens of strategists the breadth is just too narrow. How narrow? The graph below compares the present combined weighting of the 10 largest stocks by market cap in the Wilshire 5000 index, which effectively represents the entire market, with the same figures 10 years ago and 23 years ago during the dot-com bubble. Even in 2000, the weighting in the top 10 at 20.3%, which much lighter than today. What's more interesting are the returns these heavyweights post. In the past top 10's weighted returns, the darker bars on the right were trumped by the overall market gray bars. Not this time. So enormous is the current concentration impact. Not only are we seeing a greater concentration, we're also seeing more dependence on the return contribution. Put differently, there has seldom or never been less reward for taking a risk of investing in stocks outside of the biggest mega caps. There has seldom or never been, let me say it again, less reward for taking the risk of investing in stocks outside of the biggest mega caps. More signs that this rally may not have legs by looking under the hood are this data compiled by Bloomberg, which shows more stocks made 52-week lows than 52-week highs in May. Pretty amazing. And then what recession? We've been braced for what is accurately known as the most anticipated recession in U.S. history. I can relate, for more than a year now. Yet consensus dictates the economy hasn't yet entered one. Sarah Malik, Chief Investment Officer at Nuveen, for one, wrote on Monday that she expects a mild recession sometime in 2024. Growth dampening effects of tight monetary policy work their way through the economy at that point. Recessions have a simple effect on bull markets. The latter can't start until the economy has entered the former. So the bull market can't start until we enter a recession, if indeed we're going to have one. Using the Dow, which is a flawed index, but it's got a long history, we find that the sole exception came in the bull market that started in 1942 as the war effort cranked into full speed. The economy had just sustained an even bigger shock than it suffered many years later from COVID-19. A related point is that stock market tends to wait until the Fed has started cutting rates. In other words, when a recession is either imminent or already started, before making a low. If this rally is a new bull market, it's the very first to start while the Fed is still hiking. Isn't that interesting? If a recession has only been delayed, it would be very strange if the low for the stock market were already in, and that's our base case, right, folks? Or at least that's our case for being careful. It's very odd for a bull market to start at this point in the economic cycle. I could not agree more. He goes on here to talk about it's so overbought. I made that case, and you can see here. I used 2 standard deviations above the 20-day moving average. Here it is above the 50-day moving average. And you can see where we are right here, right? Really overbought. And he points these red circles, and you can see what happened after, apparently not there, but after these overbought spots. So with hindsight, it's conceivable that we'll say we're already in a secular bull phase. Whether the market goes through the low or not, these are historically strange times, to put it mildly. But the clearest message is that nobody should assume that U.S. stocks will rise in a straight line from here just because they've gained 20% from the low. Folks, we couldn't agree with that more, and let me just reiterate once again, we really don't give, frankly, a rat's rear end whether we're in a bull market or a bear market, or let's say the textbook definition. What we care about right now is, more than anything else, it's general conditions. It's the macro, globally, what's going on in the economy, what's going on with inflation, even geopolitics. That's even part of our equity market conditions index. It's also the character, we're talking about stocks, the character of the equity market, and is it representing real bargains right here relative to the overall macro setup? Unequivocally, it's not. And I don't know that a lot of people would argue about that. The most ardent bulls will always argue about that or argue with that. We would love to be bullish. There's nothing more fun than being bullish when conditions dictate that you should be. Longtime clients, you know intimately what it's like when we are bullish. We were huge bulls between the two bubbles. We've been bulls since the March bottom in 2009, or maybe just a little bit thereafter, all the way through to the late summer, early fall of 2019. Since having experienced, in my case, everything since 1984, we've really sharpened our tools. Long-term clients, you've really seen how we've evolved it as a firm in terms of the depth and the breadth of our analysis and our ability to creatively and dynamically protect portfolios when our indicators say that they need to be protected, but still do well on a risk-adjusted basis throughout. So that's what we aim to achieve going forward. So folks, that I know went long. I'll jump in and edit it down to size. Really appreciate you staying with me this long. This article from John Authors was pretty compelling to me, and that's why I thought I would just give you the benefit of running through it with you, because I think he does just a wonderful job of painting both the new bull market case versus this is just a bear market rally case. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.